Hello and welcome to Community Candor, our online financial workshop. The title of today's session is Considering Home Ownership, and this is part of our Show Me the Money Day uh, program, and we are doing this in partnership with Comerica Bank. The Money Sense series. I'm super excited to have Comerica as a part of this. This is our I was going to say this is our fifth annual, but I'm actually not sure if it's our fifth year doing this. We've been doing this for quite a while. Super excited to be here again today talking about home ownership. Just some information about Show Me the Money Day. It's an annual statewide event that kicks off tax season, and it's designed to connect financial education and resources to the community. Just a couple of key items for our audience to be aware of. There is a survey. We would like to get your feedback um, to know if this topic and this information was helpful and if there are other topics that you're interested in. Please fill out the survey. Just a note, there's a resource guide that Comerica is providing. And if you fill out the survey, then we'll have your email and your contact information. We can send that out to you. So again, we'll share that again in case you missed it. But there is a survey and we would like to get some feedback from you. So before we jump into introductions, I'd just like to mention that this series is hosted by Communities First. Communities First is a nonprofit organization, and we have been doing this work for 15 years now. Our mission is to build healthy, vibrant communities through economic development, affordable housing, and innovative programming. And we are excited to have this platform where we can bring this information to you. And so I'm going to go ahead and ask that our guests from Comerica introduce themselves before we get started and learn more about this topic. So please feel free. Whoever
Okay,
wants to go first.
absolutely. Renee, thank you so much. My name is Kevin Watkins. I am the External Affairs Manager at Comerica Bank, and I'm also our National African American Business Development Manager. I also have my colleague, Eyad Jian. Eyad, do you want to introduce yourself?
Thanks, Kevin. Thanks, Renee. My name is Eyad Jian. I'm the Director of Corporate Planning and Development here at Comerica. I've been with the company for almost 15 years now. This is one of the things that I like to do to really share some of the knowledge we gained throughout our careers with the community for financial education. I do believe this is very essential for everyone to understand and know how to kind of position themselves to direct their families and their financial health as well. Thank you for having me today.
Yes, thank you both for joining us. So as I mentioned, our topic is considering home ownership. And we hear that home ownership often used as a wealth building tool. And so I'm really excited to hear the information that you're going to present as we think about, how homeowners can build wealth, and some of the benefits, but also risks associated with becoming a homeowner. We know that having knowledge and resources can help you be well prepared to take this major step. So let's go ahead and get this presentation up on the screen, and I will turn it over to the Comerica team to share this great resource with us.
Thank you. I will start here, and of course, Kevin can jump in as well and offer some of his input as well. As you all know, there are so many different views when we think about home ownership. There are so many things for us to consider as well. So today we'll talk about so many different things in terms of what should we consider, what are the other considerations in terms of paying for a house, mortgage, down payments. How do we even think about going into the entire process? What should we do to prepare, right? So preparation is as important as doing every single step that a bank or a credit union may require as we're getting a mortgage, for example. Uh, as part of that, we will talk about and think about what other things we have to consider. How can we prepare for home ownership? This is the largest expense everybody basically makes, right? So, largest purchase that we make in our lifetime, and we want to make sure we're well prepared. So, that makes it much easier, and often it will actually make it happen than just kind of jumping in the deep end and trying to swim. So that's how I always think about it from that standpoint. We'll go to the agenda, the next slide, and kind of consider a few things that we will cover, among other things, in the presentation today. And the first thing is, as you can imagine, is the cost and the responsibilities associated with owning a home. What happens, what's the total purchase price? What are the other things that you have to consider as you, kind of pursue acquiring a home or purchasing, especially if it's your first home, from down payment, from other costs that you have. How can you actually pay for the home? Do you need a mortgage? What are the different types of options to getting a loan, the different types of organizations? There are things we might not consider that we want to learn about today. And as you think about all what goes on to get a mortgage and purchase a home, there's so many new terms that will come across today, and we'll try to kind of spend a few minutes on each term to really kind of prepare you to understand all these different things when you're talking to the mortgage company or the bank or your financial advisor, whoever is trying to help you get that mortgage, or even if you're talking to a realtor helping you find a home, then you will understand a lot of these terms and help you kind of prepare from today. It's really a journey, how I think about it. So it will take a lot to kind of get there. So that being said, we'll go to the next slide and kind of start diving into this presentation. Here you can see there are a few items, and we're going to dive into them on the next slide. But if we think about this slide and you say, what are the pros and cons of owning a home, for example. So you think about it, is there really a disadvantage of owning a home? There could be, because we have to actually pay for it. We have to maintain it. We are responsible for it. So each one of these items will have an advantage and a disadvantage. There are a lot of benefits. There are a lot of challenges that come to us when we own a home. Or something could break, the water heater could break, and then all of a sudden we have to go and purchase a water heater and have somebody come install it, etc. So there's a lot of good things, and there are a lot of challenges that also come and that we have to consider as we go on our journey here. So that's why I say preparation is key in every single step here. We'll go to the next slide and dive into each one of these and kind of give examples of the pros and cons of each one of these major considerations. So the first one is, your home is an asset. What does that mean? Is that over time, as you pay down your mortgage, which everybody, generally speaking, kind of starts with a mortgage, as you pay that off, over time, you will own that asset, right? Just like any other asset, just like the cash that you might have in a bank account, or a stock that you may own, or a car that is paid off, that becomes something yours and you could live there. However, you have to actually pay for that mortgage. There are things that you have to always maintain. So the con there is that you have to make payments. There are things that we pay that will not get back. However, in general, home prices might go up, right? And home values would appreciate over time. That's at least what the history tells us. However, we always have to consider if you have to sell a home, the price could actually go down at the time that you need to sell it. So we have to have all the considerations in place, understand why should we own a home versus rent a home or rent a place that we can live in and not have some of the responsibilities that come with home ownership. The second thing is making these payments, right? So on a monthly basis, you have to make payments. Those payments are really paying off your home, so eventually that home becomes yours. Some of the financial advisors out there would have a lot of recommendations on how long does it take to pay off a home, etc. But really, all of these are case by case basis. Every single one of us have their own unique uh, um, uh, kind of life and things that we have to consider. Taxes. This is a big thing. I mean, we pay taxes on everything, and there are property taxes that we have to pay on a home. Even if we own that home outright, we have to continue paying taxes on the value of that home. There are certain things that you would consider when it comes to taxes. There are state by state laws and regulations and exemptions and things that are available out there as well. But generally speaking, you have to pay taxes, you have to pay insurance on your home, so you can protect your home and your investment at that point as well. Another thing that has a benefit is that you can actually do whatever you want to do with your home. You can remodel it, you can paint it, you can change anything in your home. However, there's the cost that comes with that. And if someone is planning on selling that home and trying to make some renovations, some of these renovations may not pay off. Some of them are not going to be beneficial to someone else. For example, one of the biggest things here in Texas that we have is foundation issues because of the soil. That's just kind of the nature that we have. And someone having foundation issues, that's not going to really increase the value of your home. You might be spending a lot of money just to bring it up to standards. So there are a lot of considerations as we have seen on this slide, and we'll continue talking about these throughout the presentation as they come up. But those are always two sides of every story, and you have to prepare and consider each one of them as you kind of move forward with your home buying process. Next slide, please. These are some of the common terms that you will come across as you think of home ownership, and especially on the mortgage side. So when you consider buying a home, there are a lot of things that you have to think about. And the first thing that you have to understand and kind of fully consider is the income that someone generates on a monthly basis, right? And that could be coming from any different source. You could be salaries, it could be, Social Security, income that you get from investments, etc. And why this is very important, it's because it will determine how much home you can afford. It will determine the amount of mortgage you can afford to pay as well. So something like this is very clear and that's why it's on the top of this list. What's also important when we talk about income history is that it's not just a one-time thing, or that income only came in over the last few months or only the last 6 or 12 months. Lenders and mortgage companies like to think about a person, and they like to think of that history as a stable, sustainable history. That's why they ask for 2 or 3 years of income tax returns. They ask for 2 or 3 years of W-2 or months of pay stubs, etc., to understand how long have you been working at a place, how much money you've been making throughout that time, so that your history can actually support the future of your obligations and the payments that you have to make. That takes us to another very important term when applying for a mortgage, which is debt to income ratio. That debt to income ratio, how lenders and financial institutions calculate that number is very important too. And this is basically, think about it, all the obligations you have. If you have a car loan or a credit card loan or anything like that, they will add all of these things up in addition to all your mortgage payment, monthly mortgage and interest payment, in addition to the taxes, property taxes, etc. And they want that to be less than, in general, less than 43% of your total income. And the reason for that is so a person can actually cover their obligations and still have other resources available to spend on other things. You know, the utilities, other bills that we all have on monthly basis, groceries, etc. So there's this percentage that they calculated over time and came up with, so they can actually think that the person will be able to afford a home and still be able to maintain an appropriate spending habits on other things as well. Credit score. This is important because at the beginning of getting a mortgage, that's the first thing a lender would look at. And this is something that you can actually look at and review on your own as well. We'll talk about credit scores and credit reports later on in the presentation in more detail. But this is something important because it's a score that can determine, your financial health, if you will. This is something that a lender will take and say this person is going to get the best interest rate, or they're going to have a higher interest rate on their mortgage, therefore really impacting your monthly payment, right? So that's why preparation is important here, because someone could actually improve their credit score over time as they prepare for home ownership. And it could take 6 months, 12 months, couple of years to save for the down payment, improve the credit score, look at other things that you can actually improve so you're ready for that home ownership. There are a few things you could tweak about financial habits, spending habits, etc., that could improve all of these things that we just talked about, right? um, if you have a steady income, then you have to kind of control the other items that you have and you see here on the screen. If you improve your credit score, you could maybe pay down a credit card, maybe pay down something else that you have to really get that debt to income ratio to an appropriate level, and therefore also improve your credit score and help yourself save money on a monthly basis by improving those items. And then the last item here, the major item on the screen, is the down payment. And this is how much do you put down on that mortgage on the purchase of the home. So if the home is, $100,000 and your down payment is 5%, that means it's $5,000 in addition to other costs that you will have when originating that mortgage. So with that, we'll move to the next slide to dig a little bit deeper. On this slide, we have a few more items to think about and consider. The first one, capacity. This is kind of basically, I like to tie this to the debt to income ratio, right? It's how much capacity do we have? How much can we spend on our future obligations, right? And just like it says, your present and future ability to meet your payment obligations. So everything that you have today or in the future with this new mortgage, how much is the percentage of your income that you're spending on everything related to debt. Capital, this talks about everything that you own. Like, think about the net worth, think about everything that we accumulate over time that is an asset, such as a home, a car, cash, investments, anything that you have like that can be used to really build your financial well-being and financial health. And that also takes us to the next topic, which is collateral here. Any of these items could be used to secure a loan, for example. The biggest asset that normally is used by mortgage companies or banks and credit unions is the house itself that you are purchasing. So the mortgage is really secured by that home. So you always have to remember that's how they are protected. That's what's protecting their that loan for the bank or credit union. However, you have to still kind of think of your obligations because you're putting some money down. You're invested in this. They're invested in this. So when everyone's interest is aligned, they feel better about giving that loan. uh, the history, everything we do, paying our bills on time, right? Making good on our commitments on the loans that we have and obtain over time. That kind of builds that history for you, your credit report, your credit score, and the more positives on that report, the better. The higher the credit score, for example, the lower interest that you pay. So at one point, if someone has very good or excellent credit, that same exact loan is going to be cheaper for them on a monthly basis than someone else with a lower credit score, for example. So that's kind of the history that someone builds, and what I kind of mentioned earlier, that you can work on to really improve your financial well-being and an overall credit score. The conditions, these are things that, why are you getting this loan? What is it going to be used for? The specific property, your obligations that you have to maintain, insurance, etc. So a lot of things that this loan is going to be conditioned on. So you always need to understand that this is now you're actually in this together with a financial institution that's helping you make this home purchase, and also really at the same time they have certain needs that they need to secure this property, they have to secure this loan, make sure you're able to afford this property and it's the right thing for you at the same time. We'll move to the next slide. Now we kind of start diving into some of these financial habits that we talked about. The preparation, for example, when someone goes to a bank, for example, to get a mortgage, they will ask for so many different things, right? And as part of that, we need to be prepared, understanding, what are we spending money on? What are our monthly expenses, our monthly income, current obligations? And this page is very clear because it really kind of differentiates between needs and wants. Um, I do agree nowadays cable TV is a want, but maybe cell phone is a need in my opinion. I'm just that's how I think about it, because you actually need to communicate or go to work or communicate with your family. But a lot of people kind of would put these in different buckets. Um, but some of these things, when you put them on a paper and start preparing, you could actually start cutting down some of the expenses on the one side and really focus on your needs. Maybe you can build that down payment at that point in time. So that's why this is very important. Not everybody does this. Not everybody sets a budget or understands what they're spending money on. And at the end of the day, there are small things that we do every day or every week that might add up to a lot of money every single year. And that could be a large part of your down payment that you could save if you set a plan and you proceed with that plan. So that's why this is important. And in the guide that we will share with you via email as well, you'll have a lot of these worksheets you can fill out and understand how do you manage your spending habits, your financial health in general. Next slide, please. This slide talks about debt to income ratio and how it's really calculated. So it's really important to think about this and always understand your debt to income ratio, because it will play into every single loan you could be obtaining as well. Excuse me. So the debt side is every single thing that someone has as a loan or debt. That includes normally the biggest item is a mortgage, any credit card payment. This is the minimum payment on the credit card, any car loan, any student loan, anything that we have as debt. It will all be added up on a monthly basis. It will be divided by your monthly gross income. So in this case, total debt is $1,700 and total monthly income is $4,000. And always keep in mind for a mortgage, they are trying to be at, lower than 43% in general. And the reason it's 43%, it's because this is will qualify a person for a conventional loan. These percentages could change at any moment in time per guidance from major agencies that purchase these loans, that guarantee some of these loans as well. But in general, you want to be a little bit lower than that. And the lower, the better, because that means your affordability increases. And also, the monthly mortgage and interest payment could change over time because, as you can imagine, that includes, they will add also, in addition to the mortgage and to the principal and interest, they will also add taxes for an escrow account. So the mortgage company will be collecting that on a monthly basis so they can pay taxes or an insurance as well for you on an annual basis. And that will increase over time if the value of the home increases, which is a good thing, a benefit like we talked about earlier. However, the taxes will increase because it's a percentage of that home's value. And also insurance might increase as well. And we've seen that happen with kind of recent changes and increases in insurance premium, etc. That will be really outside of your control. So if you're lower than that 43%, that's better because over time you might actually get there just with these increases. I will move to the next page now. Credit score, and this is, I want to kind of dive into it a little bit more. And although the credit score something that you should get in my view, and everyone should know it. Sometimes it comes with a fee. There are certain financial institutions that may offer this for free, maybe for an introductory period of some sort. So there might be a way to get it for free. But at least from a credit report standpoint, that is something that you will be able to obtain at least once a year for free as well. But the credit score, this is something, it ranges, and there are different ways to calculate it, a couple of different ways at least. But think about it, the higher the better, the closer to 850 you have, the better. But 20% of the people probably in the country will have it at the excellent level, which is above 780, 780 to 850. And then a very good score is between, 720 or 740 to 780. And then, kind of ranges below that as well. And wherever you kind of fit on that scale or that range, the higher, the better, because you get a lower interest rate on a car loan, on a mortgage, which is kind of the largest purchase we would make in our lifetime normally. And each 1%, I mean, imagine 1% is $1,000 a year on $100,000, right? If your outstanding balance is $100,000 on average, then that's gonna save you about $1,000 a year if it's 1% lower. And that's almost $100 a month, right? So that $100 could be spent on something else. So that's why it's important to keep up with this. The way how the credit score is calculated, a lot of these factors on top of this slide on the right, payment history, the amounts you owe, the length of the credit history you have, the type of credit that you use, new credit, how many times does someone check your credit, how many times did someone miss a payment, for example. All of that impacts the credit score. So that's why I was saying earlier, preparation is very important because you could actually start and make sure, you could say, in 2 years, I would like to purchase a home. I need to start saving. I need to be careful and not miss a payment, not forget a payment, etc. So you could actually build the credit score. It'll take a little bit of time, but that's something that can happen over time. Uh, I think we flashed on the screen the annualcreditreport.com that gives you the entire credit report and everything on your credit report. And one of the things I will always encourage everyone to do, look at this at least once a year. There might be an error. There might be somebody stole a credit card, and or you're a victim of identity theft and you didn't know about it. You could actually see an account that you never knew about, right, on this report, and then you could actually contact the credit bureaus that are listed on this slide as well, and make sure you report that, you dispute that, and they can help you remove it from your credit report if it's based on fraud and it's not something that is legitimate for you. It's not something that you created. It's not a credit card you actually applied for and obtained and spent the money. So anything like that could actually be removed, but you have to work with these credit bureaus. That's why preparation is very important in this case, and you can actually improve your credit score just by actually doing that and removing things that don't belong to you. We'll move to the next slide now. This slide is, I do like this slide, and I think we have some more of this in the following slides. But, you think about buying a home, there's so many things to consider in terms of the cost of buying that house. It's not just the down payment. So if you're, decided I want to save up 5% for the down payment, you actually need more money to purchase that home, right? And there are a lot of calculators out there that can help you figure that out. A lot of financial institutions would have a calculator on their website. There are websites we'll share with you later on in this presentation that could help you think about that as well for miscellaneous costs and closing costs as well. We'll now dive into each one of these here as well. The first one is the down payment, and this is normally the biggest. The down payment could range from 3 to 20%, and this will also follow the type of mortgage that you are receiving. Certain mortgages that are guaranteed by government agencies might have a lower down payment. Some of them would have a higher down payment. And the importance about the 20% number here, what's important about it is at that point you determine if or the financial institution will determine if you're going to pay private mortgage insurance or not. And we'll talk about private mortgage insurance here shortly. However, saving up 20% could be a large amount of money, right? So waiting that long to purchase a home might be just a long period of time. And instead of doing that, you could actually make a smaller down payment and then own that home and maybe save as you're going about paying off that home, and then eventually get to that 20% and remove that private mortgage insurance. I heard financial advisors advise, against sometimes against doing that. Some of them do say yes, go and do it as soon as possible, so you can actually build that value of your home. And instead of renting and paying rent, there's some advantages of owning a home. So there are a lot of points of view on this topic, but at least you'll have an understanding of what does that mean for you. The other item is that from a monthly payment standpoint, the higher the down payment you pay, the lower that monthly mortgage payment that you will have. Just like these examples we're seeing on this screen, someone is having a higher down payment with even a lower interest rate. In this case, on the right side, they're paying more in interest if they have a smaller down payment. Next Slide, please. This slide is important because there's a lot of costs, as I mentioned. There are a lot of considerations that we have, and we might not think of every single item here. Miscellaneous costs. So you saved up your down payment, maybe it's 5%, and now you think, okay, I'm ready to go make that purchase. However, there are a lot of things that you will probably pay for. There are things that are not part of the closing costs, like, for example, an inspection. So when you purchase a home, it is important, at least in my opinion, to go get an inspector who is someone really specializes in looking at these homes and in various things. And the largest things about a home is they look at the foundation, they look at the roof, they look at the electric system, plumbing, etc., and they make sure that things are either working right, the way how they should be working. If they're not working, they're going to write that in their report. And at that point, that's where the repair cost for that becomes a negotiation point between the buyer and seller of the property. And then if you thought that's gonna cost a lot of money and the seller is not willing to pay for it, you could actually walk away from that property. But that cost is something that you actually have to pay for that professional, because you hire him to come and do this work for you. So you protect your investment and make sure there isn't a big problem that's going to come up right after you purchase that home. Other miscellaneous costs like appraisal cost, how much does this really, what's the value of that property, etc. The taxes that you have to pay, kind of prepay on some of these taxes, insurance, some other costs as well. So there are a lot of things that you have to consider. It's not just the down payment, and some calculators out there may define this as 1% to 3%. Some of them say, just whatever you have for the down payment, if it's 3 to 5%, double that, and that's kind of what you need to start when you purchase a home. But there are a lot of different views, and I always like to be conservative on these things, because you don't want to be short a few $100s or a couple of $1,000s making a very large purchase like this when you're actually making the move. So it could be a few months more, and you could actually make that purchase. Next slide, please. Closing costs. So this is something that you will pay to the title company, and there are costs that will go to the mortgage company, like the appraisal fee, and then there are things that you have to pay, and some of these are really set aside for you in an escrow account, like taxes and insurance. There is an insurance payment that has to come out and go to the insurance company right away. And there are taxes that the mortgage company would have to make on your behalf if you have an escrow account. Now, if you opt not to have an escrow account, and if your mortgage allows you not to have an escrow account, you have to remember that you have to save up that money, because at the end of the year, you have to make all these payments for the insurance company, for the taxes, the property taxes on that home as well. And here they kind of use that closing costs may vary between 2 to 5% of the purchase price. So on a $100,000 home, for example, if you're saving 5% for a down payment, you probably want to save another 5% or so to cover all these other costs as well. So it might end up between 7 to 10% cost to really purchase that home. Next page, please. Private mortgage insurance, and this is why this is important. This is an insurance that you are purchasing for the lender, basically. Why? Because if you invest less than 20%, your down payment is less than 20%, the mortgage company may say, you know what, I need a little bit more guarantee from the homeowner that they are really willing to share the risk with me, right? So that's kind of why this exists. The borrower would pay it and stop paying it at about when that amount reaches 20%. Let's say you're making your monthly payments, you purchased your home, and over time you know that the value of that home went up. At some point in time, if you think it's kind of getting closer to that 20%, you could have a new appraisal done, you could talk to your lender and have a new appraisal done. And if it really hits that 20% mark, even if you only paid a smaller amount than the original 20%, but because the appreciation in value, if the value of that home appreciated, you could actually drop your mortgage, your private mortgage insurance. So this is something that is important to keep in mind. If you have PMI or private mortgage insurance, at some point in time, you should always think about what's the value of this home. Did it appreciate enough that I could actually talk to the mortgage company and see what I need to drop this private mortgage insurance? Because this only, just like any other insurance payment we make, it really doesn't reduce the principal of that mortgage. Next slide, please. On this slide, we'll talk briefly about various types of mortgages, and you can find a lot of information about this on some of the following slides that we will have. But the major type is conventional loans, and this is where there's kind of a predetermined set of characteristics that define these loans, like debt to income ratio of maximum of 43%, for example. Certain credit scores, certain things about these loans that would make them qualify. And these are generally made by banks, financial institutions, mortgage companies, credit unions, etc. There are other types of loans, and they may also have different requirements for a down payment because of the guarantees that they may have. So some of these government agencies and federal agencies really may guarantee some of these loans or a portion of these loans. Therefore, the person who qualifies would be able to get either a different interest rate, or not to have to pay private mortgage insurance, or get a different type of loan, or qualify for a 3% down payment instead of 5% or more. So the Federal Housing Administration, Veterans Administration, USDA, Rural Development Services, these are all organizations and agencies that would provide different types of guarantees and programs and different types of loans under these programs for qualified participants. Next slide, please. This slide really talks about all the resources that you have, and there's a lot more resources as well. You could listen to a podcast about the information and educate yourself, like you're listening to this educational session here. And if you go to any of these government websites, you will have an independent view on what does this mean. It's not really just a financial institution try to give you or sell a product. It's really general information with the purpose of this information to really educate all of us on what is a mortgage, what do you need, how do you think about home ownership. You might need to know information about flood areas. You might need information about so many different things that we might not think about on a daily basis, because buying a home, as we mentioned, there's a lot of new terms. There are a lot of different things to consider. So there are a lot of free resources here that I would encourage you to go and educate yourself and plan. I cannot emphasize planning enough in this situation. Next. This is kind of the summary of this entire presentation. I hope you gained a good amount of new information, learned some new terminology, and understood how you can actually prepare and always think about your financial health and financial well-being. Really, it starts with educating yourself, understanding all these considerations that you have. And this is a long journey. It doesn't just happen quickly. So, think about what you need to do to improve your credit score, look at annual credit report, look at all the things that you need in addition to a down payment to purchasing a home, all the responsibilities that come with owning a home, such as maintaining that home. You're in charge of the AC unit or the heat or the water heater, etc. So all of that comes with home ownership. And think about all of that. Think about, if you own a home and you have to move for a job, right? That's a big consideration because you might have to sell that home. You might have to sell it at a time where the value of that home is lower. So there are a lot of considerations for home ownership, but there are a lot of benefits as well for home ownership. It's some people say this is a forced savings plan. Why? Because you're actually making your payment, and you will own a home at the end of that term, right? And at that point, you're only making your insurance and taxes on that property. So um, that really concludes our session for today. I really appreciate you all listening to us. We will share, as I mentioned, some of the information as well with you following this session. And we're always here for questions and follow-ups as well. Uh, Kevin, Renee, anything else you would like to offer?
Kevin, I'll let you go first.
Absolutely, absolutely. Thank you, Eyad. That's a very insightful presentation into considering home ownership. So, we truly appreciate you and everything that you've been able to share. There's just a few items that I just wanted to touch on, and I'll speak from Comerica's perspective because that's what I'm familiar with. But when you look at underwriting requirements, different financial institutions, they're going to have different underwriting requirements. And those are basically the rules around how they approve people for loans. So, one of the major underwriting requirements that we have is we require 3 open trade lines for a minimum of 2 years. So, essentially, what that means is individual has to have 3 items that impact their credit report. For a 2 years time period. So that could be a credit card, it could be a mortgage loan, it could be a personal loan, it could be a student loan. So as long as you're repaying those items and it shows that you've been repaying them for 2 years. So you could have 3 credit cards, you can have 2 credit cards and a car loan, you can have a credit card, a car loan, a personal loan. So as long as you have those items and you've been paying them back for 2 years, that's really going to that'll get your foot in the door as far as our underwriting requirements. Now, I'm not sure about other banks. I would assume traditional banks are fairly similar in that regard, as they're looking for individuals to have some sort of established credit history. So that is one thing that I wanted to share. And another resource I do want to share with you all is a website called Bankrate. BANKRATE.com. As a matter of fact, I will put it in the chat and hopefully we can get it shared. But on that particular website, Eyad, he was talking about different calculators, right, that individuals have access to. So you can go on there, you can you can input all of the numbers as far as a mortgage calculator, and you can see if you can, if you make an additional payment every single year, if you put an additional, couple $100s per month towards your principal of your payment, how much sooner will your loan be paid off? You can get an amortization schedule. And when you get that amortization schedule, it gives you a breakdown. How much of your payment is going towards principal? How much of your payment is going towards interest? And then your balance on a continual basis, from month 1 all the way down to month 360, if it's a 30-year loan, right? So that's just another resource that I wanted to share with you all. And then I'll pass it to Renee. So Renee, if you have any specific questions or anything you wanted to ask us.
First, I want to say thank you. Thank you for being here today and going through this information. I think really important to understand that preparation, getting prepared to be a homeowner, not just, and it's not just about credit, but understanding the cost, understanding the benefits, and so I appreciate you going through that. Um, I'd like to just maybe highlight one thing that we see when people are getting ready to make a big financial decision. A lot of times, conversations are had with their inner circles, right? And so, talking to somebody at work or somebody, a neighbor, um, or social media for advice. What would you recommend if somebody was interested in buying a house, starting that process? Um, and had more questions than answers, is that the time to visit their bank and talk to a lender to understand the process, or do they have to have all their ducks in a row before they approach the bank?
Yeah, I would certainly say if you don't feel comfortable going into your bank and asking those questions, then I would maybe thinking about choosing another bank, because you should feel comfortable to go in, ask any question that you have. You don't have to have everything together, because it from looking at social media and influencers and all these other individuals that may or may not be gurus, that may or may not be the information that you truly need in order to step into that home. So definitely talk to your bank representative. If it's a mortgage company you're working through, talk to them, get to know them. One thing that I see a lot of individuals where they make a mistake on is before they close on their house, like let's say they've been pre-approved, they have submitted an offer, their offer has been accepted, um, you know, they're almost ready to close, like they're very close, but then they change jobs, or they go and buy something on credit. They buy a new car, they buy furniture. When you do any one of those things, like if you add on new credit or new debt, that can potentially increase your debt to income ratio, and you'll be above that 43% that Eyad was talking about, and then you may not qualify. You may be so close to that finish line, but you're not going to get it because you took on this additional amount of debt. Also, if you change jobs, most underwriting requirements want you to stay in that same job for at least 2 years. So now, if you change jobs right before you close, they're not going to be able to count your income in that debt to income ratio, and then that number will be, not at the level where it needs to be. So I would refrain from changing jobs, refrain from taking on additional debt, and then also feel free, or you should feel comfortable talking to your bank, or mortgage or credit union or mortgage company, whoever it is, about any aspect of the mortgage loan process. So that's what they're there for. And then, of course, you want to use like a licensed real estate agent, someone that's proficient in that particular area as far as negotiating the contracts and the terms, the purchase agreement, the inspection. So hopefully, you have a great real estate agent, you have a great bank or mortgage company, and then they can combine their forces and make it a hopefully a seamless and a pain free, as pain free as possible experience for you.
Yes, thank you, Kevin. I appreciate you going through that. Um, these are the individuals that you should be talking to because they have the information and the resources, and you don't have to be ready. And feel free to ask questions. When you go to talk to a bank, you don't have to be in a position where you even expect to walk out with an approval. But what you should expect is some sort of plan or path to get you to an approval. And I'd just like to touch on really quickly, we hear about a lot of credit repair programs, um, scams out there. Um, do banks offer or have relationships with organizations that can help people with homeowner counseling and repair and things like that so that some of those scams can be avoided?
Yeah, that's a very good question. I am actually going to take a look at a few resources that we have. One organization that I know for sure that we have vetted is Green Path. So we know for sure Green Path is a legitimate organization. They're very reputable. They have a history of being able to help individuals uh, clear up any debt issues that they have. So when you talk about credit repair, that's really going to be one of those particular organizations that we have vetted. Also, the National Foundation for Credit Counseling, they are a good resource as well, and also the Financial Coaching Association of America. So I would say those three organizations we have vetted, and we recognize them as legitimate credit counseling services.
Okay.
And what I want to add to that is one of the courses I also like to teach is about that. And if it's too good to be true, it's probably if it's not right. So that's just a general question we can ask ourselves. And as I mentioned earlier in the presentation, if it's something legitimate on someone's account on their credit report, maybe you actually did not pay a credit card, that's not something that can be removed,
Mhm.
right? Even bankruptcy cannot be removed till 7 or 10 years, depending on what type of bankruptcy it is. So the only thing that can really be removed and repaired is, scams or fraud or things like that. So it's always important to remember that type of information.
Yeah, thank you for that. And it's actually very easy to clear those type of items. Well, I shouldn't say easy, but it's something that an individual can do themselves to clear up those type of issues on their credit through disputes and some of the online features. So thank you for sharing those additional resources, Kevin. I know you mentioned a few that can assist people with um, credit issues that they may have. And so we'll make sure that for those that fill out the survey, go ahead and plug that survey again, that in addition to the resource guide that goes along with this presentation that we had today, we'll also make sure we send out those additional resources that Kevin shared. Um, any other comments, or is there a particular takeaway that you want the audience to walk away with today coming from this presentation?
I'll start and Kevin can go. And so to me, it's a case by case situation. There is no two people with the same exact financial position. And that's why I do agree with Kevin 100%. You should go talk to you know, your bank, your local bank, credit union, whoever you actually bank with. This is very important for you. You're in charge of your entire situation. You cannot get a mortgage in 5 minutes, right? I mean, getting a mortgage takes a long time anyway, right? So preparing for that mortgage would take a much longer time frame. So don't be afraid. Talk to someone you can trust, and then get what you need to do it. I mean, I've been working in banking my entire career, but I still go talk to my banker when I need to get a mortgage because it's a very big and complicated topic, and the rules and regulations change all the time. So there might be even something that you thought about, 10 years ago when you bought your first mortgage or your first house. Things may have changed, and now you actually have to do something different. So you'll educate yourself, prepare and plan, and then make that experience a success by doing so.
Thank you for that. And it looks like we may have lost Kevin, but I want to thank you both for joining us today, providing this information. A lot of golden nuggets, I think, were shared. Um, and the topic was considering home ownership, but it's really the journey to home ownership, right? Because there are several steps and considerations that people need to think about when making such a large purchase. And so, thank you for sharing some resources that will be helpful. We do have some follow-up information that we'll send out to those that complete the survey. Thank you to Comerica for hosting this Comerica Bank Money Sense series. And we look forward to our next presentation with them, where we'll be covering some information on preparing for retirement, whether you're close to it or it's a couple of years out. There's certainly some considerations and some, I guess, maybe some nervousness about what to do in the current economic times. So we'll be covering that. Thank you for joining us, and see you next time.
Thank you. Have a great
Thank you
day.
so much. Take care.